Hello, good evening. Welcome to the webinar. Here is Boris Sapozhnikov, and we have a webinar today about mortgages, about renewal, refinancing, and all-in-one mortgages. So I would like to start with disclaimer. Information is made available to you as a self-help tool for your independent use and are not intended to provide investment advice. I cannot and don't guarantee their applicability or accuracy regarding your individual circumstances. All examples are typical and are for illustrative purposes. I encourage you to seek personalized advice. So let's start with tips for mortgage renewal. So what is a mortgage renewal? So when we take mortgage, we usually take mortgage for 20, 25, 30 years. And we are not paying the same amount interest or toward our mortgage during all this period. Because in Canada, we have small periods that we call terms. And in every term, you have to renegotiate your mortgage. So when you're doing mortgage renewal, it usually happens in average in 5 years, in some cases in 7 or 10 years, in some cases in less, in 2 or 3 years. Every time that you're doing mortgage renewal, you can negotiate your terms. So what exactly you can negotiate? You can negotiate interest rate, you can negotiate how you will pay, maybe weekly, maybe bi-weekly, maybe monthly, semi-monthly. And usually when you're doing renewal, you need to look in your financial goals. You need to look not only what is happening with your house and how much interest you pay on your mortgage, you also need to look on your other expenses. In the future examples, I will show exactly where and what type of mortgages we have and why it's important to have, first of all, clear understanding of your financial goals. So, during the mortgage renewal, consider your current financial goals, not just about your mortgage. Start shop around early, like something around 120 days before your renewal date. Always ask for better mortgage rate, and it's obvious. And when you speak to your current lender, ask them to hold a rate for you. Why it's important? So when you hold a rate with your current lender, you have time to shop around and maybe find something better, maybe better rate, maybe better terms, or maybe even to do changes to the structure of your mortgage. Every mortgage structured differently, and today I'm going to show why it's important to structure your mortgage appropriate. What kind of documents you need if you want to do renewal with the help of mortgage broker? So you need to have a mortgage renewal letter from your current lender. You need to show proof of your income. And of course, you need to show proof that you own this home and you have a proper property insurance on this home. What I'm speaking right now, it's an insurance or property insurance. Every household that has a mortgage has a proper property insurance. Okay, so what is the renewal? It's when the term or short period of your mortgage ending and you can renegotiate or even switch a lender. What is one of the interesting facts, Statistics Canada showing that at least 30% of customers or people who hold mortgages, they just renew their mortgage automatically with their current lender. They're not even trying to shop around. What happened for these 30% customers? 99% of these customers losing money on interest or losing money because of improper structure of their mortgages. So I am strongly encourage everyone who is coming to renewal, not just sign paper with your current lender, shop around, or ask mortgage broker to help you with your decision. Refinancing. So what is a refinancing and how it's different from renewal? So I hope it's clear right now that renewal it's happen on certain date and depends what is your mortgage term. Refinancing can happen on renewal date or it can happen anytime as you wish. So basically any homeowner at any point of time can decide to refinance their mortgage. And what is a refinancing process? Refinancing is a process that you take a new loan and replace your existing loan. So you have completely new mortgage and you replace the mortgage that you had before. When I have a renewal process and I just switch lender or stay with the same lender, I'm taking mortgage as is and just moving it from one place to another place. It's important to remember, so during renewal process, if you had insurance on your mortgage, when you purchase a home, you had only 5, 10 or 15% down payment, so less than 20% down payment, you have a mortgage insurance. So when you move in your mortgage, make sure that you moving your mortgage together with this insurance. By moving mortgage with insurance, you make sure that you will get the best interest rate. So refinancing actually process that canceling your insurance, because during the refinancing process you change your mortgage. How you can change your mortgage? You can change amortization period. You can change how you pay. You can change the structure. For example, you can add to your mortgage another mortgage or even mortgages, or add HELOC to your mortgage. So you can do a lot of different things, and by doing this, you may win or lose. What I mean by that you can win on interest costs, or you can lose on interest costs. So you need to do this process carefully and taking into account everything. So actual process of refinancing, it's very similar as you take mortgage at the beginning. So you need to apply and do all process from the beginning. By the way, when you doing renewal and you switching lender, also you need to reapply as from the beginning. In general, refinancing is good if you can get a better interest rate. It's just in general, but in the future examples I will show, so sometimes you can do refinancing even with higher interest rate and still pay less interest and save a lot of money on your mortgage. And this is exactly a purpose of this webinar. My main goal on this webinar show that interest rate is good, but a right structure of the mortgage is even better. I forgot to mention that during the webinar you can ask questions. I will do some stops in the middle of presentation and I will answer on questions. You can type your questions and I will make sure to answer on all of them. Okay, I just checked. I don't see any questions at this point. So If you have questions, something unclear, don't hesitate and please ask questions. And I will go to the next page. So on the first example, I want to show very simple standard refinancing process. What I see here is I see home value home 500, balance on mortgage 370, existing mortgage rate 3.7, was initially took for 5 years. Because of this high interest rate, monthly payment $2,441, and interest cost until the end of the term, not for all 5 years. Please be like, this point is very important. Not for all 5 years, just until the end of the term. So somebody already who owns this home, they already started to pay. So this $26,000, it's just interest until the end of their term. They are not at the beginning. They're kind of close to the end. And this is what their interest cost. Interest cost with this interest rate for 5 years is much more hard. So why I'm speaking just about interest cost until the end of the term? So if you want to break your mortgage, it only works on mainly it's worse when you break it before the end of the term and interest cost is not so high, and overall you can get a better deal until the end of your current term. So for example, your total term 5 years, you're already paying 3 years, you have 2 years before the end. So we are checking here during the refinancing process, so your interest cost too high during these last 2 years, not during all the 5 years. So this family checked what is the cost of refinancing, 7,000. Why it's so high? Because of high penalties. So basically what they want, they have 370 on their mortgage. They want to add another 7,000, so it will be 377,000. And this will be a new mortgage. This family got interest rate 2.49%. So their new payment monthly will be lower, $2,266. And the new interest cost until the end of the term at the same term is already $17,800. So already we can see here, so this family, by switching from 3.7 to 2.49, they will pay less interest during this specific term or until the end of this specific term. How should I calculate everything? So what I take in consideration, I take initial interest cost, 26,000. I am adding total cost of refinancing, lawyers, penalties, everything together with a new interest, and I'm subtracting initial interest cost minus what I will pay in new condition plus all my cost of refinancing. You can see the total saving is $1,224. Sometimes people say, oh, so what I save here, just $1,000. It's not worth all this headache. I need to prepare all paperwork. I need to go to the mortgage broker. He will shop for interest. I need to do this with the lawyer. Yes, it will take time. So yes, you need to collect documents. Yes, we need to find lawyer. And maybe $1,000 is not too much, but actually I checked in average all process to find lawyer. Usually it's the same lawyer that was at the beginning of your purchase, or your mortgage broker can help and get a lawyer for you. So you don't really need to look for a lawyer. You don't really need to go and shop around, mortgage broker shop for you and find the better rates that you have. And eventually, so what we have here, we have here that you saving $1,000 and you maybe in the worst scenario will spend something like 6 or 7 hours to look in. Of course, if you make more than $1,000 in 6 or 8 hours, all this story, it's not worth for you. If you make in like one work day something like $2,000, you don't really need it. Okay, so what I'm trying to say here, so for the most of Canadians who has a mortgages on the home with this or similar interest rate, this $1,000 it's actually save a lot of money. Why? Because you save on interest, you start to pay less monthly, you have some free cash that you on monthly basis. So it's very good option. Let's look on the example number 2. Same family has a home 500,000, balance on mortgage 370, the same story at the beginning, the same story with the same family, and the same cost of refinancing. And refinancing mortgage $377,000. But this family has changed their goal or changed what they want to do. They told that they want reduce their monthly payments. They don't want to pay monthly $2,441. They want to pay much less, if it's possible, because 2,266 is relatively close to 2,441, and they say if they already refinance, they want to see a bigger difference. So they don't really were happy about $1,000-something saving on interest. For what is more important to them is pay less monthly. So what I am as a mortgage broker suggested them to do, change amortization, change a number of years that they actually pay for their mortgage. By changing amortization, look what happened. I was able to reduce their payment to $1,687 monthly. They still save on interest, almost $900. But look what is a huge difference in payments. Instead to pay monthly $2,400, they pay $1,687. So approximately $700 monthly. Somebody can say, oh, but they will pay their mortgage longer. Yes, they will pay their mortgage longer, but in this current, on next 5 years period, they will have low interest rate, they will save on interest, and in addition to this, they will save on payments, and they have $700 every month extra to use to other goals. So if you remember at the beginning of the presentation, I said it's very important to know what is your actual goal. Why you are doing this refinancing? Are you just hunting for the rate? If you're just hunting for the rate, maybe it's not even worth it. But if your goal to pay less monthly and use this money for investment or purchasing maybe another car, or helping to pay your son or daughter university tutoring, or whatever. So based on your financial goals, broker should help you to change a structure of your mortgage. Okay, so I hope this example was clear. I'm going just to check if maybe any questions here. I don't see any questions, so it's good. And let's move forward to the next example. Okay. Spoke to this family, and what I found, so actually they have other loans. Okay. So look, the same home, 500. Same balance on the mortgage, 370. Same interest rate, same payment monthly, same interest cost until the end of the term, everything the same. What is the different? So what I was able to discover, they have some loans, $20,000 outstanding balance, under 5%, $877 monthly, this is what they pay for the next 2 years. Total interest cost on these other loans, about $1,000. So again, I discussed everything with this family and I said, maybe it's better to do something different. Let's put it under the home. So we had 370. I'm adding 20,000, so it's 390 plus total cost of refinancing 7,000. So we get number $397,000. Maybe you're wondering why I'm always put sign under 80%. Usually refinancing done under 80%. What do I mean by under 80%? So if you have mortgage on your home, so refinancing process usually done under 80%. So 500, 80% from 500 is 400,000. So 397,000 it's under 400,000. So we are good here. Yeah. So basically, what I'm trying to do. So I'm trying to put everything together under this low interest rate, and what we will get. New payment 1,700. Oh, sorry, I skipped to. I need to return. Okay. So next payment. So new payment $1,776. But please don't forget, previous payment was 2,441 plus 877. So look how much we were able to save monthly for the next 2 years for this family. Instead to pay next 2 years 2,441 plus 877, this family will start to pay just 1,776, and so a saving, it's enormous saving here. It's around $1,500. $1,500 in saving monthly. So every time that somebody comes to me to speak about mortgages, I'm looking on all entire financials. Why? Because this small discovery made huge change for this family. Because for the next 2 years, they can forget about these loans and they will even not feel these loans anymore because they will just pay monthly $1,776 instead to pay $2,441 plus 877. Enormous savings. I'm checking with the formula that it still works. So what I am put here, interest cost on mortgage plus interest cost on the loan for 220,000 and minus new interest cost plus refinancing cost, and we still saving on interest. So not just monthly payments, also family winning in general in interest. Again, I'm reminding, if you have any questions, please don't hesitate, ask your questions. And this example, I love this example. Why? Main reason why I love this example, because here I'm going to show how if I have a mortgage with good interest rate, 2.7, but if I have other bad credit or other loans or something expensive that I need to pay for another 5 years, and why it's expensive? Because I have a bad credit or something happened to my credit because of certain circumstances, I'm going to show how much I can save. So look on this family. This family has a home, the same home, $500,000. The balance on the mortgage, $200,000. And they have existing mortgage rate, 2.7. Good rate, not bad rate for today's market, not bad at all. And they pay monthly for this mortgage around $1,000. Interest cost until the end of the term, $24,000. And this family has a loans. Because they had a bad credit, when they apply for loans, this is what interest they got on their loan. It's happened frequently, especially when you want to buy some kind of nice car that costs around $40,000 and you have a bad credit because of, doesn't matter what circumstances. This is interest rate that usually this may happen. And look what will be interest cost for these loans. $22,000. So look, for this car that costs only $40,000, this family will pay $22,000 in interest. Almost the same amount of interest that they pay for their mortgage for the same period. This is how it works. Like if you have a bad or problem with your credit cards and you should carry balance and you pay high interest rate on your credit cards, always look in the option change or refinance your mortgage and put all these bad debts and problems that you have in your credit cards or any other loans under your mortgage. Because when you do this, you can save a lot of money. Total cost of refinancing for this family was only $4,000. Why? Because it's much lower balance on their mortgage. So total mortgage will be 200 plus 40, 244, including refinancing. So because of bad credit, I was not able and I will not be able to find good interest rate for when you have a bad credit. So this family should go to higher interest rate. So what plan I'm applying here in these circumstances? I'm dividing 5 years for the 2-year period and 3-year period. In 2-year period, we will pay higher interest rate, but we will repair our credit and make sure in 2-year period we will be ready to return to normal or standard interest rate. So I'm dividing for 2 periods, 2 years high interest and 3 years normal standard interest rate. A new payment, $1,300, it's monthly payment on this 5%. So new payment higher than 1,000, but it's less than 1,000 plus 800. So basically this family will pay, I will save for this family $500 monthly. So it sounds how it can be that instead 2.7 interest rate, now I'm paying to refinance plus I'm getting 5% interest rate, but I'm saving monthly $500. Yes, it's possible just because when you change high interest rate to the low interest rate, this is only in this case it's possible. Okay, so what I'm basically doing, taking debts with higher interest and put under the mortgage, adding this to the mortgage. So a new interest cost will be $23,000 because of 5% interest, and $70,000 for the rest 3 years. And look on all calculation here. So what was before? If family was not doing anything, just continue their life, paying 1,800, saying, I don't want all this paperwork, I don't care. So they will continue to pay all their interest, and their total interest will be in 5 years more than $46,000. And by spending 4,000 plus 23,000 interest for high interest mortgage and normal interest for the normal interest rate, this family, even with all these changes in paperwork, not just saving monthly $500, they also saving in total of their interest. Okay, so I believe you are a little bit tired from all these examples. So what I am suggesting here, take your time and maybe ask some questions. I will give in a minute, and I will check some messages that come to my phone. Yeah, sorry. Yeah, I just paused to answer on the message that I got directly on my phone. I don't see any messages right now on my YouTube channel right here. So please don't hesitate to ask questions, and I will continue presentation. So we are starting. So we spoke about renewal. It's when you move mortgage just from one lender to another or stay with the same lender at the point of time that was originally in your contract. Like for example, contract was for 5 years, so after 5 years you should renew. So or you decide to stay with the same lender or you move to another lender. It depends whatever you will decide to do at this point. Yeah, refinancing. I hope you understand that by refinancing, you can change a structure of your mortgage. You can put other debts under your mortgage. You can stretch your mortgage, reduce payments. You can save a lot of money. And it's actually my job. My main job as a mortgage broker is not to find the best interest rate. Sometimes people say, oh, the mortgage broker job is find the better interest rate. Yes, but it's true, but not total true. It's very small part of the mortgage broker job. And I am personally strongly believer if person wants to find better interest rate and will shop around, they can find interest rate on even very good interest rate. And maybe he will not be able, or she will not be able to find better interest rates than mortgage broker, but still it's possible to find a very good interest rate. But in previous examples, I showed that it's not only interest rate. You need to know what to do with your mortgage, how to restructure, how to move maybe other loans and put under other. This is a job of mortgage broker, like main part of the job of mortgage broker, to help you with your total financials, not just with interest rate. Okay, so in this part of presentation, I want to speak about the all-in-one mortgages. All-in-one mortgages is not completely new in Canada. They exist already several years, and several banks structured all-in-one mortgages differently. Even some credit unions started to structure all-in-one mortgages, and maybe you heard about Step Mortgage, it's Scotiabank, is very similar to all-in-one mortgage. So what is the general idea of all-in-one mortgage? General idea of all-in-one mortgage, so you have normal mortgage, like kind of standard mortgage. You have access to HELOC. It's a type of mortgage when you have a simple interest rate there, and you can kind of get direct access to your equity. What do I mean access to your equity? Like, look, for example, you have home for $500,000 and you paid down and now your mortgage is $350,000. 80% from 500 is 400. So basically a difference between 400 and 350 is 50. And this 50,000 is just under your roof of your home and you don't have access to this 50. But you can structure your mortgage by this way, so you will have access to this. So how you will have access? You can actually borrow under your home, under low interest rate, and use it to whatever you need. You can use it for investment, you can use for certain purchases, and in general, it's much more cheaper than doing any other loans, because private loans very expensive. No normal loans that you take even for your car, except some certain circumstances when dealers have some discounts for 0% interest rate or 2% interest rate, but in general they have like 5, 7, 15% interest rates. So when you want to avoid this, you need HELOC, the part of the structure of your mortgage that will get you access to your equity so you can borrow and return money whenever you want or whenever you need. So let's look on this picture. So this is a home, okay? So how this family live? This family have a home that value $500,000. They have a normal mortgage, $250,000. They have other debts, $80,000, and they have some kind of borrowing room, $70,000. This is exactly what I spoke about the HELOC. Remember, I just said that it's equity. It's a free equity in the home that in general or normal or standard mortgage, you don't have access to this. You can't borrow the $70,000. You can't take this out. It's locked. It's locked under the roof of your home. When you have HELOC, you can get access to this portion. Idea of all-in-one mortgages, or main secret of all-in-one mortgages, to make sure that all these parts, green part, $70,000, borrowed part, $80,000, or yellow part, main mortgage, $250,000, all these parts will have some type of connection and will work together. How it may happen? Usually, when you get money on your checking account, they just in your checking account, and when you need, you pay your bills, you pay your credit cards, and of course you pay your mortgage. In this structure, all-in-one structure, you don't have checking, you don't have mortgage account, you don't have some kind of loans, everything under one roof, under the roof of your home, or everything in all-in-one account. What is good about it? When you will get your salary, let's say your boss pay you $1,000 bi-weekly, okay? Very simple salary, $1,000 bi-weekly, you got your money in your checking account. This money comes to your checking account, and whenever you need, you will take this money for whatever you need. In all-in-one structure, this $1,000 immediately apply to this portion, whereas your debts and mortgage balance. So your green area, your HELOC, instead of $70,000 increase, and you have $71,000 access under your roof. And every day that you have this 71,000 under your roof, this $1,000 work for you. This money work for you because this you will not pay any interest on this $1,000 because it's your $1,000. You can say me, oh, but in my checking, I also, when I put $1,000, I'm not paying for the interest when I put $1,000. But here's different story. This $1,000 decreases your mortgage by $1,000. So you pay less for your mortgage because interest will be calculated on the portion that under $1,000. Now look, another salary come to your account and another salary come to your account. So you have income from your wife. Okay, maybe you have 2 jobs, so you get several times income. So basically, every time that money come to your account, they're saying to AllInOne Mortgage, they're doing like kind of command. They put command on the mortgage. They say, okay, now please recalculate for the rest. And it's not happen on regular mortgages. When you have regular mortgage, only amount that you transfer automatically or by check, whatever is set up in your account, whenever money transfer to your mortgage account, once a month or once a week or bi-weekly, this is when you pay down your mortgage. Here, you immediately pay for your mortgage. So people usually ask me question, if I pay for mortgage, where money to live? And here is the point. This $1,000 just temporary stopping your mortgage, and you have time to take this money from your account whenever you want. So if you need to pay for your credit card, and you usually pay for your credit card once a month or twice a month, so all these other days, when this $1,000 or this $2,000, when they stay in your AllInOne account, they are saying to AllInOne Mortgage, no interest. No interest for $1,000. So let's say I got salary today. Today is November 18. I got $1,000 from my employer. Okay? So today I got $1,000. I'm not paying any interest for this $1,000. Tomorrow 19, I'm not paying any interest for this $1,000. 20, I'm not paying. 21, I'm not paying. 22, I'm not paying. 23, I decided to take $100 and use my debit card and pay for something. So I'm using and paying. So what is the money on my account? $900. $900 continue to work for me. They continue to say command, don't pay for interest. Don't put any money for the interest. So mortgage kind of in frozen condition, partially, not all the mortgage. Main mortgage continue to behave as a normal mortgage, but all this part behave differently. Not only this, when it's time to pay for mortgage, as soon as I pay, for example, $1,000 toward my balance and $1,000 that I pay toward mortgage is divided interest and equity. Interest go just for interest, and 400 it's actually toward my home. In normal mortgage world, or what we usually happen with any standard lender, this 400 is locked under my roof, and I don't have access to this. Here, in this structure, I have access to this, and I can take this money out and reborrow and do whatever I want with this. It's opened a lot of opportunities for people who wants to buy a real estate, like additional real estate, invest in real estate. It's opened a lot of opportunities to people who is struggling, like for example, in the period of COVID, you're struggling, maybe you don't have enough income, so you can use this money from your roof, and you don't need to apply for this. Like people sometimes say, oh, I need to apply for loan, I need to apply for loan. Oh, it's holiday. Yes, next month we have a holiday season. We have a Black Friday. Who wants to go for Black Friday? I want to go. Everyone to go for Black Friday. Maybe I will find a nice TV, but I don't have a money in account. So what people do? They borrow with a credit card, pay high interest, and after say, okay, whatever. No, it's not whatever. It's after another debt. It's a problem. So what is the solution? If your mortgage structured as all-in-one, and you borrow not from your credit card, you can use credit card, but actually you borrow from under the roof of your home, and even if you will not be able to pay it immediately, it will be much lower interest, and today this interest rate around 3%, compared to 19% or 22% of credit card, or compare the private or personal loans that can be 10%, it's much more lower interest. So I want to stop and maybe to look any questions here. I don't see any questions. Okay, great. So maybe it's clear or opposite complicated. Again, if you have any questions, you have a chat, YouTube chat. Don't hesitate to ask me any questions that you may have. Okay, so let's go forward. I want to show a simple example. So family had a home 500,000, the balance on the mortgage 400,000, and I love this example. Why? Because family was so happy they got 1.7 interest rate. Is it a good interest rate? Yes, amazing. In today's mortgage world, you will not be able to get access to this interest rate. So let's say family got this interest rate. Maybe they got several months ago when interest rates were lower. Okay, they got interest rate 1.7, they're happy. After 5 years, what happened to this family? This is what will be a balance for this family. And all total interest cost, this mortgage for 25 years, this is what they will pay in interest in 25 years. If interest rate will stay 1.7 for all 25 years. Anybody believe that interest rate will stay 1.7 for all 25 years with now inflation in Canada? I personally don't believe. I'm pretty sure that in 5 years this family will start to pay much higher interest. So this 90,000 is not real amount. It's much more higher amount than what this family will eventually pay for their mortgage. So they enjoy this 5 years, they have low payments, they pay just 1.7 point interest, but they're ending with a high balance on their home, and they also will end with high interest. So how I structure all-in-one banking account? I am dividing this $400,000 on 2 sub-accounts. I put some money in HELOC. Remember, HELOC is something around 3% interest rate. This is a simple interest. This is where your checking, this is basically where is your checking account. So when you have $63,000, this is what you borrowed. And when you get money from your paycheck, you got $1,000 from your paycheck. So this HELOC immediately will go down to $62,000 and will stay there until you will not start to use this $1,000. So longer you're not touching your money, the longer then staying in all-in-one account, so faster you will pay down mortgage. Look, mortgage rate 2.74. This is a current, a relatively high interest rate for this mortgage. I am purposely put 2.74. I can get much better rate for this family, but I purposely put 2.74 to show the huge difference. So people were shopping for interest rate got 1.7. Instead, I put them purposely in 2.74 virtually. Okay, I can get better interest rate, but even with 2.74, with interest rates that more than 1% higher, look what will happen in 5 years. Their balance will be $267,000. So basically, how it can be? Because of difference of structure of the mortgage, because of this special all-in-one account. So basically, this family in 5 years will end with $60,000 extra dollars in their equity, and they have a direct access to this money. If they want to take the $60,000 and invest, they can. And even more important point here, they don't need to wait 5 years. They can start to invest from the day first. If they don't want to use it, they don't need. So if they will not use, they will just continue to pay what they are paying without not to change anything in their lifestyle. Look how many years it will take them. 15 years. So instead to pay mortgage in 25 years, this family will finish to pay all their mortgage in 15 years. So if you structure your mortgage appropriately, you can finish programmed 25 years in 15 years. It's hard to understand, and because of this, it's hard to understand. And because it's just PowerPoint presentation, I'm going to surprise you. I will go to the website and I'm going to show you that what I'm talking is the real numbers. So what I'm going to do, I'm going to use a real live mortgage calculator of AllInOne Mortgage. Okay, so right now we are in the screen where we in the AllInOne Mortgage Calculator. So look, please look carefully. I want to show this, and I want that you will see that numbers are real and we can do this. Another different story, I just take always 500,000 as an example. It doesn't matter what is your home value. Everything can be checked and calculated with this calculator. So let's look. Family has $500,000. Okay, this is the cost of their home. They have a mortgage $397,000 and they have borrowing room $3,000. Okay, why 3,000? Because $400,000 is the total what they allow to get access, 80% from $500,000. Okay, so let's say this family lucky, they enjoy 1.7 interest rate and they pay monthly $1,625. Amazing rate for this amount of mortgage. Everything looks perfect and monthly payments very, very low. But look what I can do with all-in-one mortgage. So I'm going to skip this step. It's about the savings. I don't want to touch people's savings. People usually afraid when they move to all-in-one mortgages, touch their savings. Let's say not touching people's savings. Going forward. This is what I discovered. Family has loan 30,000, another 30,000, this 5 interest rate, this 5% interest rate. This is monthly payments for this family. If the family has other problem, everything possible calculate. If family has line of credit or personal loan or other loans, everything can be calculated. Okay? So I hope you with me, and let's move next step. Okay. So what happened on this step? I clarify what is the family income, cash income, okay? No taxes, cash. This is what they see in their account. They see in their account this amount, $6,700. So from this amount, they need to pay $1,625 for the mortgage and other debt $760. I checked what is the other family expenses. like for groceries, maybe like clubs, clothes, whatever. Everything, this calculator has many options. Everything can be calculated. This is other family expenses. Okay, and let's go to the next step. Okay, so what I can see, if family will never change anything, they will continue to pay 25 years. This is what the interest they will pay, $90,000, similar as the previous family. And plus they need to pay for cars and everything. If they will change current way and will go to the Manulife one way, the total interest that they will pay 81,000, and they will be out and free from the house will be paid out in 15 years. 10 years of savings and $9,000 in savings on interest. Let's look on the structure of their mortgage. So their mortgage will be structured this way. HELOC or checking account or HELOC checking, whatever account you call, or Manulife One main account. This is the proper name of this account, but it's basically HELOC. So in the HELOC, family will have $107,000. On their sub-account, family will have $291,000. This is how it's properly should be structured. Okay, look on interest rate, 2.74, much more higher than 1.7. But it's possible, and family will pay out and will be free out of their mortgage. Should they go with this amortization and do exactly like this? No. We can change amortization, we can change a size of HELOC. But by changing size of HELOC, for example, I can put HELOC, like put sub account for 73 and changing HELOC to 325. It will not be so good for the family. Family will pay much more high interest, so savings will be just 6,000. If I will do opposite, I will go to the another direction and I will put just 15,000 on HELOC, and most I will put on main account. Also, it will not be good in savings. So, and if I will go here to the zero, even to the zero, if I go and main account or HELOC account will be zero, even in this scenario, we will have some savings, but not very good savings, $2,752. So how properly I need to do this? I need to put $291,000 on the main balance. Of course, maybe you will ask me a question, Boris, how you know this is 291? I'm using calculators and I'm checking what is the best scenario. For my clients, always I'm picking the best scenario. For these specific clients, with how they have their income, the best scenario and the best savings, $9,000. And this 9,000, it's not even real number. It's very small number. Real number, it will be like around 15, maybe even $20,000. It's impossible that families that get a mortgage with 1.7% for 5 years, they will continue all 25 years.